Scroll through your feed right now. Half the people are yelling gold is going to the moon, while the other half scream bubble. But while the internet panics, institutional investors are making quiet, calculated moves. Financial news networks thrive on clicks and anxiety, keeping viewers emotionally flooded. That fear pushes retail traders into a reliable trap, buying at the absolute top when the asset is already overextended, and panic selling at the very bottom. This chart shows exactly what the smart money was actually doing. Notice this tight, rhythmic compression, like a heartbeat. Then, right here in late August, long before any major Middle East headlines hit the mainstream, institutional volume expanded and money heavily flowed into gold ETFs. An ETF, or exchange-traded fund, allows large investors to buy into the gold market without having to store the physical metal. By the time you see a hedge fund manager on television talking about how great an asset is, they are usually talking up their book. They already bought in quietly, and now they need retail investors to pay a higher price so they can secure their profits. Staring at the news during a crisis actively destroys wealth. To navigate a shock, you have to turn off the television, ignore the noise, and strictly track where the capital is flowing. Every major conflict in modern history eventually comes down to one variable: who controls the fuel? That single factor dictates the timeline and the outcome of the war. Look at World War II. The Axis forces moved aggressively across North Africa until they simply ran out of fuel. Allied bombers systematically destroyed their petroleum production and supply chains, turning heavy tanks into stationary metal boxes. Fast forward to 1973. The OPEC embargo weaponized crude oil against the West. OPEC is a powerful intergovernmental organization of major oil-producing nations. Their coordinated embargo choked off global supply lines, created massive civilian fuel shortages, and spiked prices across the entire economy. The most crucial historical parallel is 1979. The Iranian Revolution delivered a severe oil shock that triggered widespread societal panic and caused consumer confidence in the established system to collapse completely. The direct market consequence of that shock was violent. Capital rushed for safety, and gold exploded from the low 200s up to the high 800s in an incredibly tight time frame. We saw the exact same mechanism during the 1991 Gulf War. When military stress threatens energy infrastructure, it forces a rapid capital rotation into perceived safe havens. The pattern repeats with heavy consistency. Whenever global oil logistics face a violent threat, gold surges, often within weeks, because institutional capital demands absolute safety. Right now, all eyes are on the Strait of Hormuz. Roughly 1/5 of all global oil flows through that narrow passage, and tensions with Iran are escalating daily. Physical blockades are rarely required to free shipping. Global insurance markets, like Lloyd's of London, abruptly reprice war risk insurance the moment conflict sparks. If truffage becomes too expensive or unavailable, tankers drop anchor and stop moving entirely. If you follow the money and the shipping lanes, you spot systemic vulnerabilities far away from the obvious Middle East headlines. You have to locate the next domino before it falls. That next domino is Cuba. As United States policy tightens around Venezuelan exports, the surrounding geographic region gets severely squeezed by the pressure. That creates critical fuel shortages and economic blackouts for nations relying on those supply networks. Cuba occupies highly strategic geography. Sitting 90 miles from Florida, it straddles the critical energy logistics lanes connecting the Caribbean and the Gulf of Mexico. Tracking insurance costs and energy logistics reveals geopolitical risk repricing in real time. The smart money positions itself long before the average person even knows what to search for online. When geopolitical stress hits, the first major capital rotation goes into physical gold and higher beta gold miners. Beta is a metric that measures how volatile a stock is compared to the broader market, meaning these mining stocks move aggressively alongside the tightening metal supply. Next is silver. It acts as a monetary hedge, but it is also a highly critical industrial component. Modern military technology creates massive baseline demand for silver during conflicts. You physically cannot build drones, guidance systems, or advanced communications networks without it. Beyond precious metals, capital moves into energy producers profiting from supply shocks, defense contractors absorbing prolonged budget increases, and stable, dividend-paying domestic utilities.
these rotations are entirely predictable. It is a strictly rules-based migration of capital out of risky positions and into sleep-at-night assets. This chart shows the 4 phases of a geopolitical market shock, a framework institutions use to strip emotion from their trading. Phase 1 is the shock. Volatility spikes, the stock index drops sharply, and safe havens like gold surge upward. Next is Phase 2, absorption. The broader market starts to stabilize and digest the news. But retail investors, completely exhausted by fear, capitulate and sell their assets at the absolute bottom. Then comes Phase 3, recovery. Smart money quietly rotates out of pure defensives and back into growth stocks. Meanwhile, traumatized retail investors stay firmly trapped in cooling safe havens because they are still afraid. Finally, Phase 4, outperformance. Driven by underlying innovation, the market pushes to new highs. The average investor, feeling safe again, ends up buying back in far too late. Operating without this 4-phase framework turns emotional retail traders into reliable, cyclical liquidity for institutional hedge funds. The real danger right now is mass self-sabotage. While everyone watches the gold chart looking for record highs, the average investor is setting themselves up to miss the wealth opportunity entirely by reacting to the wrong signals. Doom-scrolling casualty counts and reacting to headlines is a guaranteed way to lose. The winning strategy requires unwavering discipline, trusting the chart data, and completely shutting off the noise. Protecting your wealth during a geopolitical crisis doesn't require predicting the future. It requires a rigid, rules-based process that simply follows the money.